Let's talk to Craig Earlham. He is the Senior Market Strategist Analyst at Oanda. Very good morning to you, young Craig.
Good morning.
Right, specialised topic today. We've got two thought-provoking slides. Let's kick off with the first one, the Great British Pound against the US dollar. Made some new highs in recent days at the time of the recording. Obviously, the Great British Pound getting a few buyers in on the back of these Brexit headlines. Is that the truth?
Yeah, I mean, there is a lot of sensitivity in the pound to these Brexit headlines. I think what we've seen for the last 6 months really is there's been an increasing pricing of the possibility of a no-deal Brexit, this increased pessimism. So we've gone from around the kind of 142, 143 levels back to 127s. So clearly there's a lot of this being factored into the price. Obviously there is the other side of it being the dollar. But I think there's a lot of pessimism now operates in. So every time we get some good news or what sounds like potentially good news, and this is Michel Barnier saying that we're going to get effectively going to be getting a bespoke deal. This was seen as the way to get the talks progressing. It was Angela Merkel apparently was suggesting that less detail is needed as part of the exit agreement in order to try and secure a deal, and those discussions could be had later on. That's 100 pips was on the back of that. And now it seems that in recent days we've seen another little run higher on hopes that we can get this deal over the line, and then they start to get dashed last night by talk of the Brexiteers trying to potentially consider a leadership challenge to Theresa May before the year's out. So it is an up and down game right now. Lots of volatility, there's lots going on. Right, we're nearing the deadline of the Brexit deals. What's interesting though is that the buying vigour seems to be far greater than the alternative, and that suggests to me that this is maybe a sign that the pair is a little overbought, that a lot of the pessimism which we're going to see now is priced in, and barring an actual no-deal scenario, potentially we're looking at a pair that's bottomed.
So, as an exporter, okay, as Mr. Carney, he's increased his tenure to 2020. This is good news for the Great British Pound and Great Britain, isn't it?
It could be. I think it's better for the consumer. One of the downsides of the devaluation, exporters have done quite well off the back of it. Maybe the tourism industry's done quite well as well. More people coming over and flashing the cash because they've got loads of it all of a sudden. The people who've really lost out has been the consumer. So this is where we've seen high inflation because import prices have risen on the back of a weaker pound. But then on top of that as well, wages aren't rising. So we've seen this kind of negative real wage growth. So you're hoping that if the pound can stabilise and even appreciate, that should have deflationary impacts, and hopefully the end consumer will feel a little bit better off. But again, we're looking at a longer term game here.
Okay, I think it's worth noting that people should look at, if they're holding a FTSE stock, for example, okay, that basically where the earnings of that company come from, because the likes of BAT Industries and Imperial, I think 80%, 85% of their revenue comes from the US.
It's even more than that. It's 85%. I think it's around 85% of the entire FTSE 100 company earnings come from outside of the UK. So when we're talking about these relationships that you can sometimes see, these correlations, there's a very clear inverse correlation between the FTSE and the pound for that very reason that so much profits are generated abroad. If you look at things like the mining sector, for example, how much of that is in China. If you look at the financial services industry, for example, there's a huge portion of that as well in the FTSE index. A lot of this is outward facing, and the UK is in general is outward facing. So if we are going to see a stronger pound, you would expect that would maybe lead to an underperformance in the FTSE compared to its peers.
Understood. Quite often people say, okay, should I be buying my currency now for my foreign holidays? What would you say to anybody who's off on a cruise or whatever any time in 2018?
I would say it depends on your risk appetite naturally. I think if you're looking at what the probability is saying, for me the probability says that the pound continues to go higher from here. Volatility along the way, but continues to creep higher, because who in their right mind on both sides of these negotiations, outside of Jacob Rees-Mogg, etc., wants a no-deal Brexit? I think both sides know that would be quite damaging and unnecessary, so I think they will work to an agreement. And in that scenario, you'd think that would be bullish for the pound. So the probabilities suggest you can hold off and take your time. The flip side of that is the downside potential is far greater than the upside potential. So it's about your risk factor, because if you hold off and then they say no deal Brexit, cliff edge scenario, business is going to be in mayhem, I mean, the pound is going to drop at least back to post-Brexit lows, potentially further, and then obviously that can become more costly than the upside benefit would be.
Well, somebody suggested to me, don't buy it all at once. And I thought that was a bit of a cop-out,
stagger your
but
purchases,
sensible. Okay, let's move on to the second slide we've got. We've got the euro against the US dollar, the Eurodollar. Obviously, lots of political tensions in Europe at the moment. What are traders doing in this currency pair?
Yeah, I mean, as you can probably see, we had that one dip last month back to these multi-year lows, really. And I'm trying to look outside of that because we did see a quick reversal prior to September, and we came back into this kind of range which we've been at more recently, the kind of, what was it, 116 through 118 kind of trading range. I think on the one hand, you've had the dollar strength, which has come on the back of a lot of risk aversion, and I think that's what drove the moves in August. But from a more economic standpoint, I think we're looking at a situation almost where I think people want to be euro buyers. There's a lot more upside potential. The economy's still only ticking along quite slowly, far later in the recovery cycle. So there's still a long way to go from that perspective. Central bank's only just getting going on ending its QE. Possible first rate hike later on next year. But the thing that's holding it back is the fact that the Eurozone economy is now slowing a bit. Donald Trump's getting involved in trade wars right, left and centre, and Europe is one of those that's being targeted. There's negotiations actually going on at the time of speaking on this to try and forge closer trade ties, which could hopefully alleviate some of those. But you've got to wonder what impact it has on emerging markets as well, because Europe is a big exporter to emerging markets also. But all of this is having negative implications for the Eurozone economy. I think if we can start to see a rebound in the Euro economy later on this year, early next, then that should offer some uplift to the Euro. But right now we're very much in this consolidation phase, and we're not seeing anything really that's going to suggest it's going to break out. And if anything, if I'm looking at this chart right now, I'm ignoring that one big blip to the downside. Yeah. That was driven by one-off risk factors. And I'm seeing this kind of 116 floor, but the highs each time are lower. So if you're a technical analyst, or if you're looking at this from a momentum perspective, you're seeing every time we see a rally in this pair, people are deciding to sell earlier and earlier and earlier, and that tends to be a negative signal.
Right. So overall, more bearish than bullish?
I would say I'd say, without meaning to be a cop-out, I'd say I'm a bit neutral on this pair right now. I'd be leaning more towards the bearish than bullish at this moment in time. I want to be bullish in the longer term. It's okay, but as ever with this thing, it's a waiting game. So you can be right in the long run all you want. It's everything about the market is timing. And while I think this market is bullish in the long run, the question is always when's that going to come. And the chart right now for me suggests that we're going to have to wait a bit longer.
On that note, Craig, thank you very much indeed.
Thank you.